Dr. Edward Altman, the Max L. Heine Professor of Finance Emeritus at the Stern School of Business at NYU. It is so wonderful to welcome you back to the show. Great to see you, Dr. Altman. Ed, it is such a pleasure.
Thank you so much, Julia. I'm delighted to be with you today and to see you again.
Well, I'm delighted to be with you as well. And I feel like now, Dr. Altman, well, Ed, we've known each other for several years at this point. And the last time we had you on this show, for folks watching and listening, would have been after the Silicon Valley Bank collapse. So 2023, probably late spring.
Right.
And that was episode 88, if anyone wants to go back and listen. But gosh, we have to catch up because there's so much talk these days about the credit cycle, and you are the expert when it comes to all things around the credit cycle. You are the creator of the Z score, which we will certainly get into. But let's kind of start, Dr. Altman. Big picture, where we are in the credit cycle, how you are viewing the state of the economy and the outlook for the economy, more of that big picture. And as you might know, Dr. Altman, you can take all the time you need to set the table.
Well, thank you. I probably need about 8 hours, but I'll try to make it as succinct as I can. Um, I think it's very interesting, Julia, to understand not only where we are now, given the latest turmoil and concern about a recession, the tariffs, et cetera, but where we were prior to that. And I'm talking mainly about the end of 2024. And here, normally, when I look at the credit cycle, and I look at it in kind of four dimensions: benign, average, stress, and crisis. Benign, low interest rates, ample credit availability, low default rates, high recoveries if there are default, and low spreads that investors require to supply debt to companies. Spreads meaning the risk premium over the government rate. And at the end of 2024, I think on one hand, you could argue it was a benign cycle. Yes, interest rates were high. Uh, and if you looked at the high yield bond, junk bond market, defaults were quite low. And that's because um, the companies that issue those bonds took advantage of the very low interest rates during COVID and had an enormous amount of debt, which, by the way, Julia, normally in a crisis, and we had a crisis back in the pandemic days in the financial and economic markets, normally it's time to reduce risk. But COVID was really different in the sense that it motivated more risk by putting debt on the balance sheets of companies and the government. And so we had an enormous buildup in debt, which should be kept in mind in talking about what's going to happen going forward. At any rate, back in 2024, if you looked at high yield bond default rates, they were quite low. If you looked at spreads required by investors, they were incredibly low, maybe 2% below the historic average. The spreads or the risk premium that distressed or high yield investors required was only 3% compared to about 5% historic average. So things look really good. However, if you looked at the default rate and the issues in the bank loan market, the so-called bank syndicated loan market or leveraged loan market, things were quite different. For the first time in a long time, maybe ever, there was a tremendous dichotomy between defaults and activity in one leverage finance market, high yield bonds, and the other, leverage loans. And I'll get to private credit in a moment when we talk about the entire leverage finance market. But to give you an example of how different things were for bank loans, in 2024, the default rate was three times higher for bank loans than high yield bonds, close to 6% default rate for bank loans, and for bonds it was less than 2%. So something was going on, and that it was pretty easy to see. Bank loans are floating rate, so they fluctuate as the interest rate fluctuates, and particularly with high inflation, we were in a relatively high interest rate period compared to earlier years. High yield bonds, very low interest rates because they're fixed rate. And most of those were, as I said, issued during COVID at very low interest rates. So for the first time, we saw this dichotomy. For the statisticians out there, the correlation usually in the past between these two markets was almost perfect, about zero 0.9, perfect being 1.0 correlation. But in 2024, they were enormously different. So there was stress in the economy for companies that were issuing debt at a floating rate and therefore were paying and needed to pay a much higher interest rate. So it wasn't clear to many people whether we were in a benign credit cycle then or a stressed one when the default rate was more than twice the historic average for bank loans. Private debt, which we'll get into, which is an enormously important part of the leveraged finance market today, it wasn't as clear because a lot of the defaults there, and I'll get to that, are not so transparent. But there is increasing stress in that market, which I'll get into. So to answer your question now with a kind of long-winded one, it wasn't clear where we were before the latest turmoil, but it was clear that if we did not have a recession, if we did not have a big downturn in GDP, in consumer sentiment, in defaults, et cetera, then the outlook looked pretty decent at the beginning of the Trump administration. Things have changed quite a bit, as you know. There's enormous amount of uncertainty, stress in the system. Most economists are now predicting a recession with a probability greater than 50%. Of course, it's never certain, but certainly the likelihood of an increase in inflation and therefore in interest rates, even if the Fed tries to lower them, at the same time, in my opinion, no question, there's going to be more defaults among particularly small and medium-sized firms, but even large firms going forward, even if there's not a recession, but if there's a big reduction in the growth rate of our economy. And certainly if there's higher inflation, which everybody expects with the tariffs and with firms already passing along, even though they don't want to publicize it, their anticipated higher costs. Therefore, the inflation rate will no doubt increase. Whether it's temporary or more long-term, it's hard to know because we don't know how the tariffs are going to really end up. So bottom line, the economy and particularly the credit cycle that we're talking about is in a much more stressed situation than it was just a few months ago, when already it was stressed for certain types of borrowers, namely those who need to pay a higher interest rate on their loans.
Got it. Well, wonderful frame up to the conversation, Ed. And we'll post some of the charts throughout, but that credit cycle spectrum, you have the benign, average, stressed, and crisis. So it's interesting when I'm listening to you to hear stress, because that's where you start to get in the yellow on that chart. And it makes me wonder this, because when you're talking about you're foreseeing more defaults ahead affecting, small, medium-sized businesses, big businesses. Is it fair to say that defaults, bankruptcies, they're more of a leading indicator versus a lagging? And could they kind of help you understand the direction of where the economy's headed, if we're headed into a recession versus versus them being the consequence of a recession already being here?
Yeah, that's a great question. It's one that I've really given a lot of thought to and analysis in the last few years. Most economists, most credit people, or let's just say analysts with respect to the relationship between the credit cycle and the business cycle, would say that the business cycle, if not coincident, is a leading indicator of the credit cycle. In other words, when you have lots of problems in the economy, the likely impact on companies will be higher defaults. There's no question that's true. But what isn't as clear, and where I think my analysis is quite unusual compared to what most people think, is whether or not the credit cycle, and namely, as you asked, defaults, recoveries, liquidity, etc., whether the credit cycle indeed leads the business cycle. And I have some graphs that show the relationship between default rates in high yield bonds and now, more importantly, leverage loans, starting to increase from below the historic average to above it 1 to 3 years before recession sets in. And I'm convinced, based on both observation of the way companies perform and the graphs that I look at, that the credit cycle leads the business cycle. And therefore, we can look for forecasts, if you will, or at least prognostication with respect to whether we have a recession or not by what's going on in the credit markets. In other words, I would conclude that in most cycles, the credit cycle precedes, leads the business cycle. And I would guess that most economists would say that they thought the reverse, or at least that they were coincident. And that's not what I conclude. And so going forward, let's look at the trend in default rates, in liquidity. Right now, if you look at the leveraged loan market, it's clear that the trend started going up in 2023, was much greater than the historic average in 2024, as I mentioned, and could be a leading indicator. And this was even before the tariffs, even before the increase forecasts by many economists of a recession. The one dilemma I have is that the high yield market has not increased in its forecast of a recession. And that's because of the abnormally low interest rates that most companies finance their operations starting in 2020 and going through 2023. So I would say that, yeah, it's a leading indicator. And one other thing, I look at liquidity in this market as an important indicator.
Mm-hmm.
And liquidity, and to me, means, can risky companies continue to access the capital markets in a fairly benign way, in other words, not have to pay enormously high interest rates, and continue to get financing even in maybe a more challenging period. So I look at the triple C, the lowest bond rating category, new issues. And if you look at that in 2024 and particularly in 2025, they're almost non-existent. In other words, risky companies at the highest risk in the spectrum are basically closed out of the credit market today, which means if things really go south, due to a recession or not, those companies are gone. They're going to be filing for bankruptcy in increasing numbers. And by the way, that's another interesting observation. Did you know that in 2024, there were more Chapter 11 bankruptcies than any year, including the great financial cycle?
The only reason I knew that is because I read your deck, but I did not know that until then. So I would love to hear more on that because I wrote that down because that surprised me.
And it surprises a lot of people. In fact, if you talk to a lot of practitioners, they're saying, oh, kind of bankruptcy is dead. People no longer have to worry about that. Companies don't have to file. And well, that's not true. There were more filings. Of course, about 20% of the huge number in 2024. There were over 7,000 Chapter 11 bankruptcies in 2024. About 20% were small companies, under 7.5 million in liabilities, but 80% were higher. And yes, we didn't have the enormous companies that sometimes we've had in the past, particularly oil and gas companies, which, by the way, oil and gas is now under pressure for the first time since 2018. And the reason is the price of oil has now dropped into the distress zone as far as oil and gas producers are concerned, under $60 a barrel. It's not enormously below that, and so it's not a crisis yet in that industry. But once that level drops even further, you're going to see a lot more oil and gas producers and those that service the industry having financial distress. Mm-hmm. But getting back to the numbers, the reason why there were so many more bankruptcy filings, although many of them were not large enough to have high yield bonds or leveraged loans outstanding, was the floating rate nature of interest rates. So question is, are those interest rates going to stay high? And are we going to have that stagflation scenario that a lot of respected economists are now predicting?
Monetary Metals offers you the ability to grow your wealth outside the banking system and gain greater control over your finances through gold. Increase your precious metal ounces every single month. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities to earn 4% on gold, paid in gold in their marketplace. And the interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning interest in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. And for folks watching and listening, we are recording this a couple of days ahead of the FOMC, but we're running it the week after the FOMC meeting. Right. Quick question for you, Dr. Altman, or Ed. When I see corporate bankruptcies at their highest level since the global financial crisis back in 2024, highest level, does that also include this area that you've been looking into? You have a brand new paper coming out that we will get into, what's happening with these distressed exchanges, or is that number totally separate? Because a lot of folks, I want to hear more about this new technique that a lot of ailing companies are doing to avoid bankruptcy. Mm-hmm. Does it include those or not?
That's a great question. Yes, we have a new paper out on something known as distress exchanges. So let's try to separate the question of defaults. What is a default? And how do people calculate the default rate? And the other issue is one type of default are bankruptcies. So on the first level, bankruptcies themselves have escalated dramatically in 2024 and continue to be quite high, not at a record high level in 2025 so far. Though those are formal filings. And as I said, mainly small and medium-sized firms, but also probably more than $20 billion bankruptcies likely to be this year. Already, probably close to that number. Now, so bankruptcies have increased. Many of them are too small companies to impact the default rate. And the default rate is calculated based on three types of defaults: Chapter 11 filings, missed interest payment, but not yet a bankruptcy, and not cured in the 30-day grace period that companies have to pay their bonds, or 90 days to pay their loans. So bankruptcies, missed interest payment, and the third category are this thing called distressed exchanges. Now, the incredible new, it's not a new out-of-court restructuring technique, but it is new in a sense of how pervasive it is. In 2024, 73% of all defaults were these distressed exchanges. Now, admittedly, they are usually not as serious as a bankruptcy. In bankruptcy, everything is in default, and the recovery rates are generally quite low, especially to the junior creditors and certainly the shareholders. Now, what is a distressed exchange? It is a formal tender offer on the part of the company to at least some, if not all, of the creditors that the company is asking for an exchange to change the original contract that they have with the company. Usually it's a debt for debt exchange. In other words, new debt to exchange for the old debt. And that new debt is likely to have a longer maturity, so it's not going to have a liquidity event. It could have a different interest rate. It usually has higher collateral. Some way to entice the creditors to say, okay, I'm willing to change the contract. Now, usually this is a desperation play on the part of the ailing company, because if it's rejected, then the original debt is still in, it needs to be fulfilled. And if the company is having cash flow problems, it likely will go bankrupt. So it's a way to avoid bankruptcy to get this dispensation or forbearance. And the forbearance is more, not only a little bit more time to pay the interest, but to actually exchange. And there are three types of exchanges: debt for debt, equity for debt, or cash. But in all cases, the value to the old creditor is less than par value if they accept the exchange. And that's why it's called a distressed exchange. So our paper looks at what considerations should the creditor use to determine whether they accept or reject the tender offer. Now, usually, to make it a confirmed distress exchange, about 90% or more of the creditor class that's involved must say, yes, I accept. And most creditors do accept. Now, understandably, the creditor could reject it and sell their debt in the marketplace. And we find that the recovery rate, if they did that, is probably about 10 percentage points, maybe 15, higher than if the company would go bankrupt, if the company would eventually default in a more formal way. So they have the option to sell or accept. And most times they accept to avoid the likely bankruptcy. So our study looks at what actually happens to the company if they accept the exchange, the creditors accept. Do they go bankrupt anyway? Or do they have another, what we call second negative event after the initial distressed exchange? And we find that more than 50% have another or second negative event within 5 years of the distressed exchange tender offer. In other words, likelihood that those creditors who accept are going to end up worse off by holding on to the accepting the new package of securities. It could be cash, as I said, equity for debt, or debt for debt, and it's usually debt for debt. A vast majority of debt for debt. They could actually be offered equity in the company, and then the question is, if they go bankrupt anyway, the equity is likely to be wiped out, and they're going to be wiped out. So the creditor should evaluate how healthy the company looks both before and after the exchange. And we use Z-scores
We
in
should
our
talk about that.
analysis to see how sick the company is and whether or not the exchange will sufficiently um, enhance the solvency of the company. And we're finding that the company looks very sick on average before, so it needs some help. But they usually continue to have too much debt, or they haven't solved their operating problems, because a debt exchange, a distressed exchange, is a capital structure change, not an operating change. And they really need to address both to save the company in most cases.
You mentioned
Sorry
this.
if that's a
No.
long-winded
Oh, and we don't
explanation.
mind at all because the reason I love this show is I get to talk to folks like yourself who are just absolutely brilliant in their field. And I feel like we're all getting these incredible lectures and we're all learning and I love it. And we don't have any rules about long-winded answers. We actually welcome them. We love them on this show. But you mentioned the Z-score, and this is you're the creator of the Z-score, the pioneer, and it is incredibly famous. And that's how I first found you, was the Z-score, and you developed the Z-score model back in 1968. It's over 50 years old. It is still widely used today. So maybe we could start with an explanation of the Z-score, and if you'd like, has your thinking about it or the way you use it with bankruptcy prediction, has that evolved over the years? Just curious if you've noticed any sort of evolution with the Z-score.
Yes, thank you, Julia, for mentioning that. I'm as surprised as anyone that a model built is now almost 60 years ago. It'll be 60 in 3 years. Um, is still in operation and still used quite extensively by practitioners and academics as well, and government officials. And it's a global usage. It's not just the U.S. Um, Three reasons why it's still around, by the way, is one, it's quite simple. Two, it's still accurate. We estimate 80 to 90% accuracy within 2 years of predicting bankruptcy or not. And three, it's free. You don't have to pay anything for it. And it's available on most software programs. It's on the Bloomberg terminals. It's on Capital IQ. And it's easily calculated by an individual who doesn't even have access to software programs that do it for them. Now, what is it? Well, by the way, it's available on Wikipedia, Google search, whatever. So one could download it very easily, and with smartphones, program it very easily as well. Five financial indicators measuring things like liquidity of the company, profitability, leverage, uh, liquidity, and for firms that are listed on the stock exchange, we utilize market value of equity as an indicator relative to its debt. However, one thing that has evolved over the years is the fact that more and more companies in most countries, and particularly in the United States, are now privately owned. meaning they are not listed on the stock exchange, and therefore you can't access their stock price and their market value of equity. So we substitute book value of equity, even though I don't think it is good an indicator as market equity, and rerun the model to get a different set of weights or coefficients for the variables. The Z-score model was mainly built for manufacturing companies and publicly held companies. We have a model called Z double prime, which was built mainly in the mid 1990s, so 30 years later, for emerging market companies, companies overseas, and also privately held companies. So, I would guess that in the United States today, 60, 70, maybe even higher percentage of were originally listed or were large companies are now privately held, mainly by private equity firms. So the private equity firms, which by the way, we'll get to, is very important for the private credit industry and vice versa. The evolution of Z, one change was the introduction of a private firm model, a model that's also appropriate for non-manufacturers like retailers, service firms, etc. It's still not available or not appropriate for financial companies like banks, insurance companies, brokerage firms. So Z-score is mainly manufacturing or non-manufacturing, non-finance companies, which is the vast majority, but it doesn't cover financial companies, financial service companies. So Z-score has evolved in that sense. The other thing that it has evolved in is, what do you do when you get a score? What does that tell you about the company? Originally, it was bankrupt or non-bankrupt. So it was very gross description of what could happen to the company. It was useful. And even then, I published a so-called cutoff score, which was 1.8 in the Z-score model. Anything above 1.8 was likely not to fail within 2 years, and the other below 1.8 was highly likely to fail. Julia, that should never be used today. Things have changed dramatically in credit markets. For example, back in even 1990, let alone 1970, there were about 100 companies in the United States that had a AAA bond rating. Today, 2 companies, only 2 left. So why did we lose 98% of AAA companies and similar type of downgrades, so to speak, from AA and A companies? Reason? Increased leverage in the system. There were no high yield bonds then. There were no leverage loans. Private credit was not even a dream by market practitioners, except that there were some companies that specialized in small company loan lending.
Yeah, and I wonder about the proliferation of private equity as well.
And private equity, right, didn't really start until the 80s, when there were lots of hostile takeovers and the like, using high yield bonds and leverage loans as financing. I'll get back to that. So what I do now, and this I hope the listeners will embrace and look up how to do that in a couple of things that I've written since 1990s into some more recent publications of late, and that is to apply a bond rating equivalent to the score. In other words, you first calculate a score. Let's say it comes out to 1.0. Most companies have a score, I would say an average is between 1.5 and 2.5 score. whereas the average back in the 1960s was much higher. Now, for example, the average B-rated company has a score of about 1.6, which, by the way, was in the distress zone way back in 1968. Today, it's a fairly common high-yield company or leveraged loan company. So right now, the cutoff score for Z-score and for Z double prime is a score close to zero. So it's a nice, convenient way of looking at positive or negative scores imply high or lower risk. So that's the way an analyst should be using Z-score now. And no longer is that 1.8 criteria, which, by the way, I still get a lot of hate mail from people who say, oh, your model's predicting bankruptcy, and there's no way we're going bankrupt. Your model, is outdated. It's no longer relevant.
Oh, goodness.
And by the way, I hate you. And I said, well, no, don't hate me, but you should use it more appropriately and look at the bond rating equivalent of the score today. And I published those mapping, if you will, of score to ratings in a 2018 article in the Journal of Credit Risk, in our latest version of my book, one of my books on bankruptcy and distressed debt. That was published in 2019, the latest edition.
I have just the third on my desk.
And you have the third, and
Yes.
that was probably published quite a bit earlier than recently, but still, it probably had the Z double prime score discussion in there, and some discussion of mapping to ratings. The bottom line is scoring is very important, but understanding the implications of the scoring, you need to now look at more modern bond rating equivalence of the score. I know it may sound a little complicated now, but it really is not. If you look at some of the work that I've done, you can probably get, if you drill down, but not completely, from some of the software programs and the Bloomberg terminals.
Let me ask you this. Back in 2007, you warned of a great credit bubble. I don't know. I think at the time you didn't know the catalyst, it was going to be in housing per se, but now that we look at where we are in that credit cycle spectrum, and as you point out, stressed, gone from benign. Did we skip over average, or we kind of went through average? Now we're in stressed. But the next part of that phase, that cycle, is crisis.
Yes.
Do you see a crisis ahead, or what would push us into that part of the spectrum? Are there similarities that you see from going back to 2007? I only bring that up because it was such a prescient remark at the time. Would just love to hear more, because I feel like this is such an important part of the system to really understand credit, because I feel like you can probably glean so many warning signs of where things are headed.
Yeah, well, that's also an very interesting and somewhat controversial issue of what I was saying in 2007. And you're right, I did not see the catalyst, but I warned if there was a catalyst that asset prices were skyrocketed high in 2006 and 7, early 7. I did point to the fact that the housing market showed some cracks in it. There were some mutual funds, particularly those issued by Bear Stearns, that were essentially underwater, and they were mainly investors in mortgage-backed securities. And of course, people like John Paulson and The Big Short took advantage of the fact that there were a lot of subprime mortgage loans out there that had very little chance to be repaid. But that was not what I was thinking. What I was thinking is the fact that the interest rates were so low on what I considered fairly risky market, and also the fact that leverage had increased. Anything that wanted to be financed was being financed up until 2007. Now, that's not quite the situation today when I said the triple Cs now can no longer easily or even with difficulty get financed today. So there is some pullback in the market. Not that was not seen in '07. But I remember I gave a speech in Montreal about the coming crisis, and the president of the bank that was financing the speech, um, said, "Oh, if I understand what you're saying, I should now be hedging my risk rather than taking on more risk, or I should even go short credit." Um, and I said, "Well, thank you very much. That's probably what I would do." He said, "Yeah, but you don't understand my job as a CEO of a big bank. If I cut back the credit and other banks continue to apply credit, I'm going to lose my job. If my bank grows much, much less than, and if I listen to what you say and maybe the risk manager of my bank, and the party, I think the term was, the music keeps going and people keep dancing, I'm going to lose my job. But if I take your advice and you're right, I become a hero and I get a big bonus. So look at the risk return for me as a CEO of a bank. If I cut back and I'm wrong, I'm going to lose my job. If I'm right and you're right, I'm going to get a bonus. So a lot of people were saying it's not worth it for me to cut back as long as everybody else is out there, uh, uh, supplying credit. And that was the scenario in 2007. Of course, I could say the same thing now in terms of what could be the catalyst for a crisis. Now, it turns out that conveniently we have, I used conveniently in quotes, we have a potential catalyst, and that's the tariffs and the prospect of stagflation. Low growth or no growth and high inflation. And so that clearly was not forecasted at the beginning of this year. So that could be the catalyst, but it could be something else. It could be some geopolitical crisis. It could be, a war between the United States and Iran, or further escalation with China. And that certainly would rile the markets dramatically and change everything. So, and it could be a pandemic, it could be, terrible things. I don't know. I'm saying right now, we could be in a stress scenario and will likely be in a stress scenario if we have that recession, if inflation continues to be high. That won't cause a crisis. That's already embedded in asset prices today. So it has to be something else on top of that. And finally, the thing that's different today than was even in '07 is the enormous buildup in debt.
Yes.
At both the company and the government level. And so that's not going away. Things get better, okay. And maybe if interest rates drop a lot, it may not be as bad. Although it still will be bad if we have a recession. Mm-hmm. But if we have a bad recession, if we have higher inflation, if we have some geopolitical or some other catalyst, then a crisis is not only possible, but likely. I just hope we don't have, a huge catalyst that we don't expect today.
Yeah.
But clearly, if you look at the bank loan market and the amount of defaults already this year, it's not as much as last year, but it's pretty high. We're probably headed for a stress situation. We're not there yet because this dilemma between high yield bonds and bank loans. And then there's private credit. And maybe we should get to that next to talk about what impact private credit is having on the credit markets.
Yeah. Yeah, we'll make sure we post some of these charts too when you talk about the divergent signals between the high yield bonds and the bank syndicated loans, which are showing stress. We can go into private credit, happy to. And then I have another follow-on question for you as well on the government debt side, but let's go to private credit.
Okay. Well, there's no question that private credit is the new kid on the block, but also the biggest kid on the block in terms of leverage finance. There are various estimates about the size of the private credit market, and private credit is another way of saying non-bank loans, particularly to leverage finance companies, namely companies whose bond rating or implied bond rating is non-investment grade, below investment grade, double B, B, and triple C type companies, the more risky companies. That market has grown, but not because of the growth in high yield and leveraged loans. They are been stagnant in the last few years. The growth has come 100% from private credit. And so we have a very large segment of the leverage finance market that A, has grown dramatically, B, is far less regulated than the bank loan or high yield bond market, and has grown arguably to about $2.5 trillion. Now, that's about 500 to 700 billion more than most investment banks and other analysts are thinking is the size of the market. Nobody knows for sure
And it's really
because
opaque too,
it's
yeah.
a bit opaque. Yeah. And you have various types of master funds or hedge funds that are providing this credit. Some of it is more transparent, like if they're listed on the stock exchange and they're so-called BDCs, business development corporations, and they are regulated by the SEC. And so they have to have filings every quarter, their size there. But there's maybe a dichotomy between how much money they've raised and how much money they've loaned out. How much dry powder is still in these funds that has not been loaned out yet. So if you consider both what's been loaned out and what is in reserve that could be loaned out, our estimate is, and I look at some of my colleagues from the NYU Law School, one in particular, Michael O'Rourke, who has estimated that the size is about $2.5 trillion. I would say most investment banks say it's about 1.7, 1.8 trillion in the US and growing, but growing also abroad, particularly in Europe. Now, that's already larger than the other two segments. So what impact has that had on the markets? Well, one impact that most people haven't thought about, but if they think about it, agree with me. And that is this observation that I mentioned earlier, Julia, that spreads or risk premiums are much lower than the historic average, even since the Trump tariffs went into effect. So, for example, at the beginning of this year, the spread was, as I said, around 3% for high yield bonds and about 4% for leveraged loans above the risk-free rate. Historically, it's about 5%, both of them, a little bit more, a little bit less, depending on how far back in history you go. So why were they so low? And why are they still so low? Even today, the high yield bond spread is probably close to 4%, a little bit above. So still 100 basis points below the historic average. And bank syndicated loans is now about at the historic average, about 5%, a little bit higher. So why are they so low when so much risk is out there? Answer: competition between private credit and the traditional leverage finance
Interesting. Yeah.
markets. And what does competition do? It drives down rates. So an investment banker who's talking to a potential client company to issue debt saying, oh, well, you could issue debt at a pretty low rate today. So let's get into that market because of the competition with private credit. And we want to make sure that the debt issue goes out with bonds or leveraged loans rather than private credit. So they say, okay, we're going to try to, and the market has been receptive to this because interest rates are the absolute level of interest rates are still pretty good, pretty high. And so investors are fat and happy with receiving a high interest rate, even if the spread is below historic average. Now, that's changing. It's getting higher, but it's still below the historic average. And I think one reason for that is the advent and growth and competition between private credit and more traditional
Yeah.
finance.
That's a really interesting observation. Can I sneak in one question before we both have a hard stop? Is that okay? Okay.
It's okay. I have a little bit more time.
I have a hard stop in
You don't mind.
15.
Oh, you
But
do? Okay,
okay, so we
fine.
can go for
Okay.
like 10 more minutes or so if that's
Yeah,
okay. But
that's
this has
fine.
been incredible. Like I said, I love listening to you and learning from you. I want to go back, if you don't mind. You were talking about the indebtedness, and it's across many different facets of the economy. But the one I want to talk about is the government indebtedness, because you have this great chart, and this kind of it didn't surprise me, but it alarmed me a bit. US government interest payments per day have doubled from 1 billion per day before the pandemic to 3 billion per day in 2024. And the question I want to ask you, because you are someone who does deep research on corporate zombies and you examine companies, these companies that can generate just enough cash flow to service their debt, but not enough to reduce it. So, my question is, given the government's growing debt burden and interest payments, which again, as you point out, are 3 billion per day, they've tripled since 2019. Can you apply that similar distress framework to sovereign debt? Could the concept of a zombie company be applied to a national economy? Is that fair? Like, can you do that? I don't know if that would even work, but curious.
Well, actually, that's a very important question. Most analysts who look at the US government debt situation are alarmed that the debt is so high. Basically, it's 100% of GDP, or about $36 trillion. Uh, by far the highest in the world, by far. And that implies a very high interest cost per day, as you mentioned, and as we've seen. And all the forecasts that I've seen, it's going to be higher. And the reason it's going to be higher is we need to refinance the debt that is coming due. And even if there is a reduction in debt, um, um, not debt, but on expenditures by the US government, which the Trump administration is trying to realize, uh, not with a great deal of success, I might add, even though a lot of jobs have been, you know, rescinded, so to speak. Um, Most people are saying, especially if there is a tax cut, that the debt has to remain pretty high or actually grow. And that level of debt to GDP at the government level is likely to grow beyond 100%, maybe as much as 120 or 130%, within 10 years. Now, the problem is with that higher amount of debt, and everybody is more or less forecasting that, that means the government is going to have higher and higher interest costs, even if for some miracle reason, the risk of U.S. debt diminishes, which is not likely, especially as you see the weakness of the U.S. dollar of late. And so it's not likely that the interest rates will go down very much and probably will go up because of the increased need to float new debt. So what does that mean? It means that whatever cash, so to speak, is available for expenditures, an increasing percentage has to go to pay the government debt burden. It means less money for other things. And so that's always a risk for any government that increases their debt. There's no magic number of debt to GDP that once you cross the red line, so to speak, it means you're now going to be downgraded or in trouble. My concern is that we have competing interests for expenditures, and that if we cut down on the government debt, then in order to save money for the government, will that money be spent on infrastructure and other important things that we need to do to stay competitive? Um, and so that is my concern with government debt, the opportunity cost of increasing the debt limit. And there's no question they're going to have to raise the debt limit, uh, especially if they want to put through these tax cuts, which of course will reduce revenues for the government and therefore need to have whatever funding is going to be necessary to increase debt or at least keep debt at a high level. So yes, government debt is a concern. And, there's like a watch list now for the US government debt to be on downgrade again. It was downgraded once by Standard and Poor's back about more than 10 years ago. And of course, there's the European situation that now is looking much more brighter, so to speak, for the euro to actually not replace but supplement the amount of debt in the system for US dollars in the system. Bottom line, government debt is a concern. I'm not a specialist in but I could tell you one thing. You asked the question, can you look at solvency of a country like a company? And we have an algorithm for looking at how healthy a government is and its debt by looking at the health of its private sector. So what does that mean? It means that you have to have an aggregate measure of how default prone is the private sector given its economic outlook of the country. And so, yes, we use a variation on Z-score to look at the percentage of companies in a country and its value that is under stress situation. And it was very useful, by the way, to predict what happened in Europe back in 2009 to 2012, when it was very clear that the sickest countries in Europe were the ones that had the highest probability of bankruptcy of the private sector, namely Greece, Italy, Spain, Portugal. And that's exactly what happened. And, it almost imploded the euro in 2012 when, of course, a few countries did default, particularly Greece. So, bottom line, it's not a perfect measure because the banking system is really important too. But I look at the health of the private sector as an indication of the health of the public sector, rather than only looking at macroeconomic variables. That's a long-winded answer to saying it's not a perfect science, this sovereign debt default risk. And very few, if any, models have been built to accurately predict sovereign defaults. I can mention that.
Well, it was just a curiosity, but I really appreciate you. Gosh, Dr. Altman, it is always always a pleasure getting to listen to you and learn from you. Before I let you go, Ed, And then the final, like, I don't know, 90 seconds here. I'd love to have you just like leave this audience with some parting thoughts. Anything that you'd like to leave them to think about. The floor is all yours.
Well, first, root for the Knicks in the playoffs.
There you go.
They made an amazing comeback yesterday. The Celtic fans will not like that. Um, well, I guess you have to have a perspective, even though scenarios that I'm presented with you are not that bright with respect to the credit cycle. We've lived through many credit crises in the past, recessions, default rates of 10 or more percent per year for 1 or 2 years. And we've been incredibly resilient. Now, yes, we have an existential crisis right now with not only the United States, but globally due to the potential problems of tariffs. And yes, there could be some compromises made, which would reduce the stress somewhat. But that scenario is on top of a lot of underlying weakness in the credit cycle that existed even before the tariffs. So I think it means be cautious. Certainly don't increase your leverage too much now until you're confident you have the cash flows and the ability to service it, because it'll come back to bite you, even if the cost of debt is not still historically that high. With that, you know, I'm sometimes considered to be more of a bear than a bull about credit, but I like to think that we look at it rationally as well.
Dr. Ed Altman, Max L. Heine Professor of Finance Emeritus at the Stern School of Business at New York University. It has been an absolute honor to welcome you back to the show. I want to thank you again, Ed, for being so generous with your time, all of your knowledge, your wisdom, and for teaching all of us. Really appreciate you. And until next time, be well, Ed.
Thank you so much, Julia, and good luck to you as well.